Ethical behavior is a fundamental requirement of effective corporate governance, sustainable business performance, and stakeholder trust. In increasingly complex business environments characterized by global operations, technological innovation, regulatory scrutiny, and heightened stakeholder expectations, organizations require formal ethical frameworks to guide decision-making and promote responsible conduct. Within the program, corporate codes of ethics and professional codes of ethics represent two complementary mechanisms for promoting ethical behavior. Corporate codes establish standards of conduct applicable to organizational activities and stakeholder relationships, while professional codes define the ethical responsibilities of individuals belonging to recognized professions such as accountancy. Together, these codes support transparency, accountability, integrity, and responsible leadership while reinforcing the public interest and strengthening long-term organizational reputation. Ethical codes therefore operate not merely as compliance documents but as strategic governance tools that shape organizational culture and professional judgment. A corporate code of ethics is defined within the framework as the application of ethical values to business behavior. It establishes the principles, standards, and behavioral expectations that guide organizational decisions and interactions with stakeholders, ensuring that commercial objectives are pursued consistently with ethical responsibilities and corporate values. Rather than focusing exclusively on legal compliance, a corporate code seeks to create a culture of honesty, fairness, integrity, and social responsibility that influences every aspect of organizational activity. By communicating expected standards of behavior clearly, the code promotes consistency in managerial decisions while reducing ethical uncertainty and supporting responsible corporate governance. Corporate codes of ethics recognize that organizations possess responsibilities to a broad range of stakeholders rather than solely to shareholders. The program highlights several important stakeholder relationships governed by corporate ethics. Shareholders expect a fair return on their investment together with transparent information regarding how their capital is managed. Ethical organizations therefore provide accurate reporting, effective governance, and responsible stewardship of corporate resources. Employees expect fair treatment, appropriate working conditions, training opportunities, and effective health and safety arrangements, requiring organizations to respect employee rights while promoting diversity, equality, and professional development. Ethical treatment of employees contributes to organizational commitment, productivity, and long-term sustainability. Corporate ethics also shape relationships with customers, suppliers, and the wider community. Organizations have a responsibility to provide quality goods and services at reasonable prices, ensuring product safety, honest marketing, and fair commercial practices that protect customer interests. Ethical relationships with suppliers require prompt payment, objective supplier selection, and adherence to recognized standards such as fair trade principles, thereby promoting responsible supply chain management and long-term commercial partnerships. Beyond direct commercial relationships, organizations affect society through environmental impact, employment practices, and community engagement. Consequently, ethical companies increasingly publish corporate social responsibility (CSR) reports explaining how organizational activities contribute positively to wider society and sustainable development. Corporate ethics therefore integrate commercial success with broader stakeholder accountability and responsible citizenship. The framework further notes that organizational mission statements frequently incorporate ethical business values, identifying the products or services provided, financial objectives, and the organization's role within society. Embedding ethical principles within mission statements reinforces leadership commitment to responsible business conduct while aligning organizational strategy with stakeholder expectations and corporate purpose. In this way, corporate ethics become an integral component of organizational culture rather than merely a compliance requirement. Complementing organizational ethics are professional codes of ethics, which establish ethical standards governing the behavior of members of recognized professions. The accounting profession, in particular, performs a critical public interest role through financial reporting, assurance, taxation, advisory services, governance, and strategic decision-making. Consequently, accountants are expected to demonstrate high ethical standards regardless of commercial pressures or personal interests. Professional ethical codes provide a consistent framework that guides professional judgment, supports public confidence, and reinforces the integrity of financial markets and corporate governance systems. The program identifies 5 fundamental ethical principles underpinning professional conduct. The first principle is integrity, requiring members to be straightforward and honest in all professional and business relationships. Integrity establishes trust and credibility by ensuring that professional advice and financial information are truthful and reliable. The second principle is objectivity, requiring professionals not to allow bias, conflicts of interest, or undue influence to affect professional judgment. Objectivity enables accountants to provide independent advice and challenge inappropriate behavior while maintaining professional skepticism and ethical independence. The third principle is professional competence and due care, requiring members to maintain professional knowledge and skill at an appropriate level through continuous professional development and diligent performance of professional responsibilities. The fourth principle is confidentiality, requiring information obtained through professional relationships not to be disclosed without appropriate authority, except where legal or professional obligations require disclosure. This principle protects client trust while balancing confidentiality with broader public interest considerations. The final principle is professional behavior, requiring members to comply with relevant laws and regulations and avoid actions that discredit the profession.